essentially people who are late to FI in their 50s and 60s, that most of us can't afford to be waiting until we're oversaved. We'll be 75 years old. But the way that personal finance has evolved, and just about any famous guru you can think of, all of those people tend to be great at saving and accumulating, but they don't make good role models actually when it comes to spending and retiring, because they can't get over the hump of not still accumulating money. I think that we really should be approaching this, particularly us in our 50s and 60s, as, look, we did the work, we did the hard saving. Now it is time to enjoy that. I was listening to one of these guru types, and he says, well, my approach was I wanted to be oversaved, so I wanted to have twice as much money as I needed. So I decided to work till age 70, so I would have twice as much money as I needed. Now, that may be great for him, and it may be great for people who really love their jobs that much. But I don't think that's good advice for people who really want to use their money, enjoy their life, starting sometime in their 50s or 60s in particular. That the advice that is most commonly given amounts to don't spend money. That is the number one strategy of all of personal finance guru land, is don't spend money. That's why they have all these weird portfolios. Some are 80-20. It's a foundational element, although it's not the end. Put it this way, it doesn't get you to where you need to go by itself, and we can talk about that. But when you hear risk parity, all you should think of, it's a method of diversification. That's all it is. Yeah. It's not magic. It's not weird. It's not from aliens.
That's a good starting point.
People have been talking about diversification since, if you go back thousands of years, to the Talmudic portfolio, which comes out of Jewish teachings. It's 1/3 gold, 1/3 real estate, and 1/3 business.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. It's been weeks since Jackie and I have been in front of the microphone. We've seen each other twice in person in Atlanta, and she's been now to my home and seen Nirvana. So it's good to be back in the chair, back on the mic. And Jackie, Happy New Year.
Happy New Year, Bill. It was so great that our paths crossed in person over the holidays. So it was fun. So we're not just podcast co-hosts. We are friends. Got to see your lovely family, your lovely wife, your sons. So that was really cool. So now we're back at work.
Yeah. It's back to the grind. We have a hard time doing this stuff. And today we're going to have a really hard time because our guest does not like to talk. We're really going to have to bring him out of his shell.
Ha ha. He's being sarcastic for sure. You recognize that laugh.
Yeah, the laugh is a thumbprint, but he has so much to say, but it's hard for him to get it out. We'll bring it out. We can do it. We're good hosts. We've been doing this for 115 episodes, and our guest has been on before, so he's a little practiced. At any rate, let's start the show, okay? Our first thing is to give a podcast shout out, and this will give you a hint as to who our guest is. It's to Risk Parity Radio. And then, so Frank Vasquez is the host, and he's with us today. That's www.riskparityradio.com. And his charity, which we want to support, is the Father McKenna Center, which helps the homeless in Washington, D.C. And Frank is on the board, so he knows how your money gets spent. Please go to fathermckennacenter.org and make your donation in the new year today. Make it a part of your giving plan if you can, for us and for him and the people that he serves. All right. So our review of the week, Jackie, is from Vitlob, VITLOB, my favorite finance podcast. Quote,
Yay!
Great show. Late in the game or not. Most comprehensive coverage of all topics due to focusing on catching up. When I get to FI, I will donate boatloads. It is making a huge difference. So our call to action this week is we encourage all listeners to donate a little while you FI and boatloads when you FI. Go to the support tab on catchinguptofi.com and buy us a coffee. We drink boatloads of matcha tea, actually. All right, Jackie, I'm going to turn it over to you and start this long-winded introduction to a long-winded guest, Frank Vasquez.
Well, if you haven't guessed already, our guest today is Frank Vasquez. He is a mostly retired lawyer. He has over 30 years of experience in investing for his own accounts. That's how he's gotten so good. He holds degrees in economics and engineering from California Institute of Technology and a law degree from Georgetown University. Wow, he sounds impressive already, right? Frank, he is extremely active in the financial independence community. So I'm sure you have heard his name if you're in any of the groups. He's always answering all types of questions in forums and Facebook groups. He has appeared as a guest on many of your favorite financial independence podcasts, including this one. He's on episode 44, titled SpongeBob and Drawdown Strategies. We'll include that in the show notes. He runs a well-attended workshop at the Economy Conference, which is coming up in March. Bill, you and I will be there. Frank, I believe you'll be there as well. And he hosts an Ask Uncle Frank Anything thread on Thursdays in the Catching Up to 5 Facebook group. So if you're not in there, come join us in the Catching Up to 5 Facebook group community. When he says, ask me anything, he really means it, and he will answer your question. His involvement in financial independence topics and issues predates the FI community as it's known today in the dark ages. So Frank, that's just the first half of our friend Frank Vasquez. Bill, what else? When did you meet Frank?
Well, I met Frank at FinCon 2019 in Washington, D.C., his hometown. My wife and I had drinks with him and found his wit and wisdom quite entertaining. I think he actually made a pass at my wife, but I'm not sure. His laugh is an unmistakable fingerprint, and it can be heard far afield. He is the founder and host of Risk Parity Radio, a laboratory or dive bar devoted to asset allocations for the DIY investor, drawdown portfolios, AMAs with Frank, and his famous rants. One of Frank's guiding meta principles that you will hear on this show is a foolish consistency is the hobgoblin of little minds, adored by little statesmen and philosophers and divines. That's Ralph Waldo Emerson. Another, and shows his diverse interest, is absorb what is useful, discard what is useless, and add what is specifically your own. That is Bruce Lee. Most importantly, Frank loves waffles and good wine, and so do I. Now, Frank will be able to say that he's been a guest on the Catching Up to 5 podcast twice, and there are very few that can say that in this world. We are gluttons for punishment around here. We had to give him a chance to rebut another giant in the FI space, Big Earn, aka Karsten Jeske, who dissed risk parity and the 5% rule on episode 106 and threw down the gauntlet. Next time, we'll have to have both of you on for a polite smackdown MMA style in an erudite discussion on why the world is actually flat and the real value of small cap value, international equities, gold, Bitcoin, long-term treasuries, preferred shares, and butter in retirement drawdown portfolio construction. But first, welcome back, Frank, to the Catching Up to 5 podcast.
Thank you. That was quite an introduction. I don't know if I can. I'll just step out now.
You're like, is that me? That is you, my friend.
Well, there is so much more to you, and I do count you as a friend. Heck, we're actually daring to travel with you and Mary, your announcer on your podcast, spouse and partner, to South Africa this year. This is going to be interesting.
It'll be epic. In more ways than one, I'm sure. We're really looking forward.
We're trying to spend money on the way to FI, and that's one of your things in the FI community that we'll talk about. So, yeah, I mean, you are famous for your rants, but before we get to that, I understand some of your podcast listeners have likened themselves to people who are fans of the Grateful Dead. Why is that?
I'm afraid I'm missing the reference now. Oh, it's the licorice one.
Yeah.
Yeah, I think it was Jerry Garcia. They interviewed him and he said, what about people that like the Grateful Dead? And he said, well, it's like licorice. If you like licorice, you really, really like licorice. And if you don't like licorice, you don't want to go anywhere near licorice. And so that does describe the podcast I have. Either people like it a lot and they stay, or they really don't and they leave. And that's whichever way you like it is fine. Because my podcast is a hobby. It's not a commercial endeavor. And so you just get a lot of my humor and musings and other things going on in there. It's more like, as I say, if I was running a dive bar in my basement, it'd be kind of like that, because I have a lot of kind of regulars that will email in and ask about various things. And they even have like little nicknames and things. We have Alexi, who's also a doctor, We call him the dude.
Frank, I think that's why people like your advice, because you're not in it for profit. You're not trying to sell them anything. Now, sometimes you come across, you hurt my feelings a few times before I got to know you because you go right in. But I think that's why people are kind of drawn to you and the advice that you give, because you're not trying to sell anything. You're not trying to talk them into anything else except to give them your honest, well thought out opinion based on all the experience that you have. So we appreciate that. We appreciate you hanging out in our Facebook group and giving good, honest feedback.
He can be gentle. I've seen him be gentle. He has a heart. Absolutely.
It depends on who you are. It depends on who you are. Because if you are a successful person who has everything going for them, I'm going to be really hard on you. If you're struggling, if you're having a hard time, if you have things you need to overcome, I'm going to be nice to you. I think it's an inverse proportion to how well off you are. Because if you're doing well, I think you can probably do better. And if you're not doing well, we need to lift you up.
A good example of that is your Father McKenna, how you support that. And by the way, can you tell us a little bit about what Father McKenna, the nonprofit organization, does?
Yeah, the Father McKenna Center it serves homeless and hungry people in Washington, D.C. So we run a soup kitchen and have some related programs, a food pantry, and some other things. It's actually run out of the basement of an old church that is attached to a high school, Gonzaga High School, and it's right there on North Capitol Street, north of the Capitol. And so we actually have about 1,000 volunteers that work, and most of them are students at the school or other students from other schools who come to volunteer and serving the people and helping with the food and other things. And we have about 6 staff. So it's a small charity. Our budget is about $1.5 million a year that we pretty much need to raise. And so as part of what I'm trying to do in my integrated life in retirement is to take all the things that I do and bring them together. And so part of what I like to do on the podcast is promote the charity. And if you give to the charity, you get to go to the front of my email line. That's about all I have really to offer in terms of something.
That's beautiful, Frank.
Yeah, no, I do really want to thank all the people that have donated to the center, because we've really raised now tens of thousands of dollars, and it continues to pour in every week, every month. Somebody's giving, and it's really gratifying, and it really makes me feel good, and it's really helping people because this money is so efficiently used. That's what I like to tell my listeners who care about financial efficiency. We have very low overhead. We don't pay any rent because our space is provided by the school. And so almost all the dollars you give are going straight into food and services. So you're getting a lot of bang for your charitable buck, if you will. There is a nice website with a lot of more information about the center, the FatherMcKennaCenter.org. You can also donate there. We accept stock shares. If you're thinking about your QCDs or your alternative ways of giving that are tax efficient for you, we can take all of that in. And I would appreciate it if you would consider us.
I've donated, and I challenge our audience to do so. We have 6,000 new listeners every week. And if we can just get 100 or up to 1,000 to do so, think of the impact you'll make here. And I believe in small impact charities like this one. But you're not always so serious. You're known for your humor. And I want to know, what is it with SpongeBob, Talladega Nights, and the endless quips, clips, quotes, witticisms, and seemingly useless trivia that inhabits the dark corners of your bottomless mind? Did no one play with you as a small child?
I don't know. Most people have, I guess, when their mind is at rest and they're not thinking about anything, they might have an internal critic or something going on in there. I have replays of jokes and songs and commercials from my childhood. A lot of this stuff, for instance, the SpongeBob and the Talladega Nights stuff are things that we enjoyed with my children. And the original purpose of my podcast, which was like a COVID project, was simply to lay down some information to preserve it for my children as they go forward with their investing lives. What I learned is the way to get them to listen to it, and they're all in their 20s, is to put in these kinds of clips and references to SpongeBob and other things. And so since they still are the main audience or the one I care about the most, I will continue to do that. And it's one of those things that people, it's the Grateful Dead thing. Either people really like it or they really hate it. but it is what it is. So,
well, it can seem complex, but if you take it down to its fundamental parts, your show and the information you provide is actually very simple, as we'll talk about today. But again, before we do that, you love to rant. You are famous for your rants, and the one that probably applies to this show is the one we would like to call the oversaved and underspent. What do you mean by that?
I think that this really applies also because of your audience is essentially people who are late to FI in their 50s and 60s, that most of us can't afford to be waiting until we're oversaved. We'll be 75 years old. But the way that personal finance has evolved, and just about any famous guru you can think of, all of those people tend to be great at saving and accumulating, but they don't make good role models actually when it comes to spending and retiring, because they can't get over the hump of not still accumulating money. I think that we really should be approaching this, particularly us in our 50s and 60s, as look, we did the work, we did the hard saving. Now it is time to enjoy that. So what we should be focused on, and what I'm focused on in my podcast, is how can we spend the most money out of our accumulated assets, not how can we become the most oversaved. I was listening, and I won't mention his name, but just last month I was listening to one of these guru types, and he says, well, my approach was I wanted to be oversaved, so I wanted to have twice as much money as I needed. So I decided to work till age 70, so I would have twice as much money as I needed. Now, that may be great for him, and it may be great for people who really love their jobs that much. But I don't think that's good advice for people who really want to use their money, enjoy their life, starting sometime in their 50s or 60s in particular. That the advice that is most commonly given amounts to don't spend money. That is the number one strategy of all of personal finance guru land, is don't spend money. That's why they have all these weird portfolios. Some are 80-20, some are 20-80, some have buckets of cash or houses or ladders or all sorts of other things going on. If you strip it all off, their real strategy is don't spend money. And that's fine if you want to accumulate. That's fine if you want to die with the most money. If that's your goal, that's fine. I don't think that's a good goal. I don't think most people really have that goal when they think about it. And so if you don't have that goal, and if your goal is, I want to spend more money now while I can still enjoy it, then that is the kind of person that gravitates towards my podcast and what I have to say.
And we argue about 3 to 6% withdrawal rates. And as you've said, and I've heard you often repeat, at 3%, you can pretty much do whatever you want with your portfolio and you're safe. And then we have Bill Bengen 4%. We have the modern Bill Bengen of 5%. We have Frank
It's the same guy. That's another thing I like to rant about. There's a number of people in personal finance land who love 1990s Bill Bengen because he says 4%. But you ask him about what today Bill Bengen says 5%. It's like, oh, no, he's too old. He doesn't know what he's talking about anymore.
He's been on the show, and his book's coming out this fall, as we're all excited about. And he'll outline his new research. But let's turn the clock back for a minute, because risk parity has been around for decades, if not centuries and centuries. I think for our folks to understand what it is, and we'll define it along the way, where did it start? And take us through the timeline of history as its evolution, Frank. And you've done this on your show in some foundational episodes, 1, 3, 5, 7, 9, I think 13. And we want our audience to listen to those. But let's give it a high-level overview first, right, Jackie?
Yeah, because risk parity, that's probably something a lot of people hadn't heard of. I really hadn't thought a lot about it in my portfolio construction. I keep it fairly simple. But yeah, kind of break that down for us a little bit, risk parity, because that's sort of your theme when it comes to portfolio construction, right?
It's a foundational element, although it's not the end. Put it this way, it doesn't get you to where you need to go by itself, and we can talk about that. But when you hear risk parity, all you should think of, it's a method of diversification. That's all it is. Yeah. It's not magic. It's not weird. It's not from aliens.
That's a good starting point.
People have been talking about diversification since, if you go back thousands of years to the Talmudic portfolio, which comes out of Jewish teachings. It's 1/3 gold, 1/3 real estate, and 1/3 of business. As you go forward in time, though, where this really starts to form in modern parlance, if you will, is after Harry Markowitz came up with modern portfolio theory back in the 1950s and wrote the original papers about diversification. First, just talking about a diversified portfolio amongst stocks, but then applying that to multiple asset classes. That morphed over time. People recognized, after playing with it for a couple of decades, you ended up with the 60-40 portfolio. That is an idea that comes out of the 1970s and 1980s. Now, as more people became involved in really trying to diversify portfolios, the people that are really working on the forefront of that are people that ran hedge funds and people who were working in particular for large pensions and institutions who had a lot of money, and they were looking for different kinds of strategies to employ for part of or some of their assets. And this goes on today. In fact, I live in Fairfax County, Virginia. It has 1 million people in it. Their police and fire, our pension plans are managed on a risk parity basis. So that is where the original ideas came from, because only large institutions like Yale or or a pension plan or Bridgewater, where Ray Dalio is the name that is associated most with risk parity. Only they could really implement these things when you're talking about what was going on in the 1990s, like 30 years ago, because we didn't have all of the funds and ETFs that are easily available and that are cheap enough to use now. So that name, that tag risk parity, came into being about 20 some years ago and was essentially used to describe what Bridgewater, the hedge fund, was doing and what they were marketing to the pensions they served and the institutions that they worked with. After that, a number of papers were written on that topic. It is now part of it's not part of the CFP curriculum, it's part of the CFA curriculum. And there's a whole chapter in the CFA manual about just risk parity and what it is. So it is part of the whole development of ways to diversify a portfolio. And why do you want to diversify a portfolio? It goes to what Markowitz and others came up with, which is called the efficient frontier. It's basically like if you have a set of assets that you want to use for a portfolio to invest in, assets A, B, C, D, and E, there's a way to combine them to get the best risk-reward characteristics, the balance between risk and reward. And that is really what diversification is all about, is how can we combine assets so we get the most reward for unit of risk. So that gives you kind of a thumbnail sketch of risk parity. If you want to read more about it, you go back to those first episodes, 1, 3, 5, 7, and 9, and go to the show notes. There's all kinds of articles and things written describing that in more detail. The way I use that in what I'm talking about in the podcast is not in the academic or classic sense, which was to actually look at the volatility characteristics of each asset and balance them out in that way, which is a very technical or academic way of doing it. What I think was important and important for retirees is let's focus on the safe withdrawal rate as the metric, the thing we are trying to maximize. And so that simply requires making a few adjustments in what would be a classic risk parity style portfolio and creating something that has a higher safe withdrawal rate. It's essentially on a different part of the efficient frontier curve. You're taking a little bit more risk because you can get a higher safe withdrawal rate out of the mix that you're getting at. I think I need to let you ask a question.
Retirement may feel far away, but today is the perfect day to start planning. At Bolden.com, they help you take control of your financial future, whether you're years away from retirement or just a short time away. Their easy-to-use retirement planning tool is designed to help you every step of the way.
So Jackie, with Bolden.com, you can track your savings, get personalized retirement advice based on your goals, explore investment options to grow your wealth, and create a strategy that's built for your own unique needs.
Best of all, Bill, it's all in one place. Simple, secure, and tailored just for you. You don't need to be a financial expert to start planning your dream retirement. Bolden.com makes it easy and puts the power back in your hands.
So start today and take the first step towards a confident tomorrow. Visit gobolden.com/catching up and start building the retirement you deserve. That's go.bolden, BOLDIN.com/catching up.
What was confusing about that? Was that absolutely clear?
No, I was about to say, so for clarification, so this risk parity approach is primarily used for people that are managing money and portfolios for maybe large organizations like pension funds, things like that, hedge funds. And it is risk parity essentially is levels of diversification. Now you mentioned, so Ray Dalio, he's the guy that sort of, would you say he made this risk parity famous?
Yeah, that he's the name that is most commonly associated with it. And he has written about it. He was interviewed in Tony Robbins' book, Money Master the Game. And that is what really popularized Ray Dalio and risk parity.
Yeah, and I've seen him on CNBC a lot. I watch the Financial Channel.
He's retired now, and he's just out there commentating on all kinds of things financial and things that are not financial. But this was kind of his baby, if you will, that he really developed in the 1990s is where it came from. And back then, people were working with this new invention called a spreadsheet, which also tells you why we can do things like this now as do-it-yourself investors that were not possible 30 years ago.
Yeah, that's the connection I was going to make, Frank. So you're saying back in the day, it was mainly an institutional thing where only people that were managing large portfolios did it. But today's technology allows individual investors to be able to model this out and potentially do it for themselves in a fairly simple way.
That's right, because back in that time, there were no index funds. There were no ETFs. I think the first ETF was invented in about 1993. I think it was SPY. And so people that were trying to do this, they were buying individual assets. They were buying futures contracts. They were engaged in all kinds of complex partnerships and individual bonds and all sorts of things like that. You don't have to deal with individual assets like that anymore. There are ETFs for everything now, literally everything, even a lot of things you don't want. But especially since 2018 or 2019, the SEC loosened up the rules on what you could put in an ETF. And so that has led to this explosion and why ETFs are gradually taking over the landscape from mutual funds because they're more efficient and more flexible. And so the way that the world is going, in particular in personal finance land, is we are moving towards ETFs and away from mutual funds. Even though they can have the same things in them for the most part, it's really the ETF form that has allowed us to invest in specific asset classes. And I'll give you a good example. If you go 20 years ago and you wanted to get a Vanguard bond fund, they pretty much had like a couple of them. A total bond fund and maybe a corporate one and maybe some general treasury bond fund. And that was about it. These days, Vanguard has like 20 ETFs. And so, for instance, if you want short-term treasury bonds, Vanguard has an ETF for that. If you want intermediate treasury bonds, Vanguard has an ETF for that. You want long-term treasury bonds, Vanguard has an ETF for that. Vanguard has an ETF for all kinds of different corporate bonds. Vanguard has ETFs for very short-term bonds. And Vanguard's only one provider. So you can literally dial in and pick a set of asset classes now that you couldn't do 20 years ago and find inexpensive funds to fulfill those roles. And so instead of having 2 or 3 funds that try to cover the whole universe, you can have 5 or 6 funds that are more specifically invested in what you really want and then combine those. And so that is where we're really moving towards more one-size-fits-all solutions that you had 20 years ago. That's the first sort of round of index funds that really became popular in the first decade of this century has grown and morphed into all of these options.
One of the things that our audience is going to want to know, because their portfolios may be smaller as late starters, is there a price of entry? Is there an optimal minimum portfolio in order to enter this risk parity strategy before you should even think about it?
This is really for somebody in their retirement or decumulation phase. I mean, you can use these portfolios, and I know people that use these kind of portfolios to accumulate in, but they're more conservative. They're not designed for accumulation itself. If you're accumulating, follow Paul Merriman's recommendations and go 100% in stocks and have a couple of funds and you'll be fine there. So, but in terms of, is there a minimum amount? No, not anymore. That was one of the things that actually allowed me to I have sample portfolios that we talk about in the podcast and put on the website. Those are real live portfolios. They're only $10,000 each, but since they are at Fidelity, who allows you to trade with no fees and in fractional share amounts, so you can buy $1 worth of something. That is one thing that has occurred in the past few years. The barriers to entry have gone to zero, that you can create any of these kind of portfolios at literally no cost. Now, I don't think you'd want to create one with $100, but you could. And it does allow, I know a lot of my listeners, they like to what? I'll just go create another little account and put this thing in there and run it and see what it does. You literally can experiment with things and do things that you couldn't have possibly done before because the cost would have been prohibitive, even before 2020, because that's when we went to no fee trading in most places. So yeah, there isn't any minimum anymore. Although if you're trying to accumulate, you don't need something with 5 or 6 funds in it. You'd have something with 1 or 2 funds in it, or 1 to 4, I would say, is probably more than enough for that.
So when these issues, 2 of the concepts that we need to understand is the concept of correlation. This is really important in risk parity. Can you take us through what that is and how that works for the parity approach?
Sure. Correlation is a measurement of diversification. This is important for people to understand that diversification does not mean different. It doesn't mean different names. You could have 2 things that are different. They have different names, they're different investments, but they're not diversified. And how do you know whether they're diversified or not? You look at what's called the correlation number, which is based on how they have traded in the same markets at the same time in the past. And so the measurement of correlation goes from -1 to +1. If things are positively correlated, they're close to +1, that means they move together all the time and may have almost the same returns. So if you take something like a total stock market fund and an S&P 500 fund, those are something like 99.7% correlated. And they're going to be moving in the same direction and probably in almost the same magnitude all the time. And that is a very basic idea that I think amateurs need to learn first, that just because you have different funds, that is not diversification. You actually have to look at how they behave. So what you're looking at when you're trying to diversify a portfolio are things with lower correlations. And if you have 2 assets with 0 correlations, that means they don't have any relationship to each other. They move in different directions all the time. One could be up and the other one down. If you have 2 things that have a negative correlation, they tend to move in opposite directions most of the time. Now, another thing that is confusing here is that correlations change. They don't change like randomly, but they do change over time. And they change based on the overall economic environment we're living in. So there are typically, the way that an economy is divided up, and looking at this, you think of, are we in an economy with higher growth or growth that is declining? And is inflation going up or is inflation going down? If you have those 2 things and you use them like 2 axes, you basically have 4 quadrants. So we have one quadrant where growth is increasing and inflation is increasing. You have one quadrant where growth is decreasing and inflation is increasing. The opposite of that, or they can both be decreasing, in which case you're in a recession. And so each of those categorization defines a macroeconomic environment. And then if you look at each economic environment and take an asset, say a large cap growth fund or a tech fund, you can look at how that has performed in all those different environments and get an idea of how it performs. Then you can take another asset and compare it. And you'll find that in some of those economic environments, things are positively correlated. In other ones, they're negatively correlated. And that particularly comes into play when you're talking about treasury bonds, because treasury bonds will be negatively correlated with most stock market assets in recessionary environments, but they can be positively correlated in inflationary environments. I think that confuses people because there is a confusion. There is sometimes people have the idea that, either correlations are random or they are changing in some strange paradigm way that for the next 5 years they're going to be correlated, then they're not going to be correlated. And that frequently in most recent times, because you had the year 2022 when bonds and stocks showed positive correlation, some people have interpreted that as a sea change, and now there's the negative correlation is gone and we're never going to be seeing it again. It's like, wait till the next recession. In fact, wait till the last couple of years. Last year, stocks and bonds were negatively correlated again. But the importance of that over long periods of time is you can look at a general idea of what the correlations have been. And then you use that to construct a portfolio with, because you want assets that have positive returns but low correlations. They frequently are not negatively correlated. Frequently, you're just talking about lower correlations. And so even if bonds are typically 0 to negative with stocks, sometimes they're positive.
Would gold be another example?
Yeah, gold has a 0 correlation with both stocks and bonds. And that is what makes it valuable in a portfolio, because it has that 0 correlation with both stocks and bonds. If you put it into a portfolio, it will tend to reduce the overall volatility or risk profile of the portfolio greatly without reducing the overall returns very greatly. But there is an optimal amount of gold to put in a portfolio for a good safe withdrawal rate. And it happens to be between 10 and 15%. The person who ran that study is named Carsten Jeske. It's Safe Withdrawal Rate Series number 34.
That's AKA Big Earn.
He may not agree with the concept in toto of risk portfolios.
He ran it back 100 years and said, well, if you add 10 to 15% in gold to these stock and bond portfolios, it tends to increase the safe withdrawal rate of usually about 0.5%.
I don't think he holds gold in his portfolio, does he?
No.
But he does, what does he do? He does options. That's one of his hobbies.
That's a side hustle.
That's a side hustle. Okay.
I would put that in active trading, I would call a side hustle.
Okay, so that was going to be my question to you. So it sounds like you're like, some of these correlations, it depends on the inflationary environment and things like that. So it sounds like the risk parity, managing a portfolio like that, would have to be somewhat active.
Actually, it doesn't have to be.
No.
It could be.
Because I'm thinking if we're in an inflationary environment and then we're not, then you might have to do something.
But it's better just to think of this in long term.
Okay.
In longer terms, that yes, you can look at those kind of things. And that is what the professionals try to do. They look at macroeconomic environments and say, oh, well, it's a good kind of environment for this asset, so we're going to tilt towards that one and tilt away towards that one. You don't have to do that, though, as a do-it-yourself investor. And in fact, I recommend you don't do that. What I would recommend is you do what most people recommend, which is called naive diversification. In naive diversification, you come up with a set percentage allocations of what you want. 60-40, that's a naive diversification. 60% of this, 40% of that. If you have 5 things, you can have, they all could be 20s, or you can mix them in some other way. But whatever you come up with, you want to stick with that. And then you rebalance that periodically in accordance with some rules. Either you can rebalance it once a year as a common rule, or you can rebalance it if it goes so far out of whack, which is called rebalancing on bands. But you come up with a static rule so that, no, you're not thinking about this stuff. You set it and you mostly forget it, but you look at it and say, oh, it triggered the rule. My investor policy statement says I rebalance now. Poke button.
Yeah.
Then I'm done.
Well, that's my new word, naive diversification, which is what I prefer. Okay, so I'm glad you clarified that for us, because it was sort of sounding like, I know what you mean. So like the big guys are trying to do that.
That's what they pay the big bucks for, if you would.
Right.
That's what all these people that sell services, and I watch these guys on their podcasts or videos and things like that. They're selling a service like that. And it's interesting to watch. I don't think anybody needs to be doing anything like that. I think that just coming up with a nice set allocation that has worked very well in the past and is likely to work very well in the future is what you want to do, and then rebalance it.
So you have some principles, actually, that we should back up to or backtrack to that help people. You have 3 fundamental principles that you recommend that people apply in that order, actually, to sort of put together their portfolio. And so what are your cardinal principles of investing portfolio construction for our audience?
Yeah, the 3 basic principles, and I think I discussed these in detail in episode 7, are what I call the Holy Grail principle, which is it's just diversification. And the reason we call it the Holy Grail principle is Ray Dalio said, the Holy Grail of investing is to find, he said, 10 to 15 uncorrelated assets and construct a portfolio out of them. I don't know if you can find 10 to 15 uncorrelated assets, but if you can find, how about 5? And so that the Holy Grail principle is we need to find assets that are truly diversified over time and construct a portfolio out of those. The next principle is the macro allocation principle. And this one actually comes from the most neglected chapters of Common Sense Investing, Jack Bogle's famous book, are chapters 18 and 19. And this comes from that. What many studies have shown going back to the 1980s is that if you know some basic parameters of a portfolio, that it has 60% stocks or 80% stocks, in particular focusing on how much are the equities, all of those portfolios are likely to perform similarly over time. So that is one of the main things to think about when you're thinking about constructing a portfolio is how aggressive do I want this to be? This also plays into what Bill Bengen has said and others have said. And I don't know whether it was on your podcast or another one I listened to. He said this since the 1990s, that kind of the sweet spot in terms of a macro allocation for stocks in a portfolio that is going to have a high safe withdrawal rate is somewhere between 40 and 70%.
He said it on our podcast, by the way.
Yes, that is a macro allocation principle. And so the purpose of the macro allocation principle is just to get you in a ballpark. It's sort of like recognizing that I don't care which combination of stock funds you have. If your portfolio is 70% stocks, it's going to perform over time a lot like another one that's 70% stocks. And so just monkeying around with a whole bunch of different funds and adding more funds, and when you have the same macro allocation, probably isn't going to have much of an effect over time. That's one reason you don't need 10 stock funds. You can have 2 or 3 and be fine. So that's the second principle. And the third principle is the simplicity principle. And that is simply the idea that, well, let's do naive diversification. Let's not be trying to market time and looking at macro allocation factors and tilting this way or tilting that way or doing things like that. Let's use low cost funds, ETFs these days, index funds in ETF form, and let's create a portfolio that hopefully has certainly less than 10 assets in it. 5 or 6 is probably more than enough, and that's including a cash allocation. I always like to refer to Einstein with this. You want something to be as simple as possible, but no simpler. So I think the mistake I see, the zeitgeist in personal finance land, is simplicity over everything else. And I think that's wrong, that you shouldn't be worshiping some god of simplicity. And just having one fund does not make your portfolio better than one with 4 funds in it, just because it has 1 fund instead of 4 funds. That the real question is, how simple does it need to be in order to fulfill the purpose that we are serving with this portfolio, which in this case is to have a higher safe withdrawal rate? You really can't do that with 2 or 3 funds. You need between 4 and 6, probably minimum.
Very interesting. So you're putting to rest that risk parity should probably replace a little bit J.L. Collins, Bogleheads, Bill Bengen's first era, the golden fleece of the 2 to 3 point portfolio that are all accumulation portfolios, and add a couple of funds and mix them up a little bit different in the batter of your cake in order to have a drawdown portfolio that has less volatility and a higher safe withdrawal rate. Is that a good summary?
Ultimately, yeah, you always have that balance between volatility and returns, essentially, is what feeds into the safe withdrawal rate. So you're adding a few things that hopefully will not reduce the returns too much, but will greatly reduce the volatility. And that's what gives you a better portfolio for drawing down on. So another good way to illustrate or think about this is thinking about the magnitude of drawdowns and then the length of drawdowns for a particular portfolio historically. So if you have a portfolio that is 100% stocks or even a 60-40 portfolio, something that's just a stock and bond thing, those have typically had drawdowns that go up to 13 years long. So you can be underwater for up to 13 years with a portfolio like that. And that's what you should be preparing for, because that's the worst case scenario. That's where the 4% rule comes from, knowing you have this 13-year drawdown. The kinds of portfolios that we work with have drawdowns of between 3 to 4 years max. It's not average, max. I think one of the big mistakes I see going on right now in personal finance land is if you read something and somebody says, I have this strategy, this bucket strategy, whatever it is, it's designed to survive. We know that the stock market is an average drawdown of 3 years. So I'll just have this 3 years of stuff and that'll solve my problem. No, it won't. That's not your problem. Your problem is a 13-year drawdown. That's the problem you're trying to solve. How are you going to take your portfolio and create something that does not have a 13-year drawdown? And if you take a few more assets that are well diversified, you can create portfolios that have max drawdowns of 3 to 4 years.
Well, that's an important point. It really is. Jackie, what do you think?
Yeah, so I have a question for Frank. Okay, so I love the idea that you're making us to think about uncorrelated things, a little bit more about diversification in a different way. So as you're thinking about that portfolio, we should also consider assets like, let's say, if you happen to have a small pension that's coming in, that's very different than stocks, or Social Security. So those are pieces that we would want to think in terms of, I guess, our assets as a whole. And technically those aren't assets, that's income, but still it can make a difference in what the portfolio looks like because we've got some of this fixed income that's coming in no matter what.
It could, but it doesn't have to. I think if you really want to model this in the simplest and most straightforward way, the way to do it is to simply take your annual expenses, subtract off whatever that income is, whether it's Social Security.
Okay.
You
Gotcha.
get a smaller number of net expenses that then your invested portfolio needs to cover. And then just think about that separately. This needs to cover that portfolio.
Okay, that's a good way to do it. Okay.
You could do this in other ways that I see people as like, well, this one's kind of like bonds, so therefore I'm going to put this other thing. But it doesn't really work to do it that way. It makes things much more complicated. And one of the reasons it makes it so much more complicated, particularly if you have something like real estate or some kind of annuity or a pension or something like that, you can't rebalance that thing with your portfolio. Right. That is the problem.
Right. So the simplest way to do it is just to deduct it out of what you need out of the. Okay.
Yeah, it's not like a bond because you can't buy more of it or sell a piece of it. I think rental real estate is easier to think about because it's a fixed asset. You're not going to sell a piece of the shingles. But any pension is kind of like that too. You can't go in there and say, well, I'll just take a piece of this pension and sell it for extra money this year. You're not allowed to do that. And since you cannot sell or buy more of this thing, I think the better way to model it for planning purposes is simply to subtract it off of the gross expenses. Then you end up with a net expenses that need to be covered by an invested portfolio. And then you can just do that.
And Social Security, which is a superpower of the late starter audience, is one of those things as well. Don't forget about it.
Yeah. So let's say, for instance, I'm good with the examples, help me a lot. So let's say if you need $10,000 a month, right? I don't need that, but some other big guys might. So $10,000. If you're getting $5,000 between a small pension and Social Security, then as far as this risk parity portfolio, you need to set it up to where you can pull out $5,000, right?
Correct.
Because you've already got, okay, all right.
And that's true. I mean, it's true of any portfolio. I mean, I would use this modeling with any kind of retirement portfolio you're talking about at all, because I think it's the simplest and cleanest way of looking at it.
I agree.
I mean, one of the things people need to think about, and we did an episode on this back, in episode 41 with David Stein, the host of the Money for the Rest of Us podcast, is how do you analyze an investment, one of these 5 to 6 funds or real estate or whatever that goes into your portfolio. And without going through it ad nauseum, because we spent an hour on it, I want to briefly reiterate that and get any commentary that you might have on it. The first thing you need to ask yourself is, what is it, right?
Correct.
And so what is it exactly you're looking at? The second thing you need to look at is it an investment, a speculation, or a gamble? And how would you define those three, Frank?
Well, I would use David Stein's definitions because I think they're pretty good. An investment is typically something that is producing an income stream. So it is like a stock that represents a company that's producing a profit, or it's a bond that is producing an income stream, or it could be something like a real estate investment. A speculation is something that has a positive expectation. You think it's going to be worth more money in the future, but it's not creating an income stream. The technical difference between the two of them is you can use what's called a discount and cash flow analysis to analyze an investment because it has a cash flow. Something without a cash flow that could be worth more money in the future, or you think is likely to be worth more money in the future, that is a speculation.
Do you have a couple of examples?
Gold is a speculation. Bitcoin is a speculation. And it's interesting. A lot of the things that are speculations are really, what you're really counting on is that you know that the currency we work in is deteriorating over time. It's inflating itself away over time. That's a feature of our dollar. It's not a bug. It's a feature. And so anything that is going to hold value is going to go up in value in terms of dollars over time. So something that is going to be rare, like gold or artwork or a commodity or Bitcoin, anything of those nature that you have a confidence that it has a positive expectation. It will be worth more money over time. That is what you would call a speculation. And that is distinguishing it between a gamble. A gamble has a negative expectation. A gamble is what you do at the casino, that you think you are actually likely to lose money on this thing if you were to keep investing in it, gambling in it.
So would you consider penny stocks?
Penny stocks are like that because in theory, a penny stock does represent a company that is making money. But in practice, most of those companies only exist on paper.
Right.
So they're not making money. They have no cash flow. And the expectation is negative. And so, I mean, you are literally hoping that you just get lightning in a bottle, that you buy it, it goes up, and you cash in and walk away with the money, like rolling dice or playing cards or something like that.
Yeah. Hey, I was telling Bill, I went to a casino with my sister over the holidays, and it was in slots only. I'm not a big fan of slots.
I'm going to take you to a craps table.
Right. I did a few rolls or spins or whatever. I have no idea. I ended up winning $1,283, so $1,280. I'm like, oh, I'm rich. And like you said, I just cashed out, but that was a complete gamble. I usually will get $300 and I'll go entertain myself, and that's what I do.
Yeah.
So I had no expectation of like actually earning anything. So that's the gamble. That's the gamble.
That's why gambling is fun, because the outcome is uncertain and you could win. You could be, some people are going to win. It might as well be you.
All right. Well, we're going to do the craps tables, and I love blackjack too, so I can play that.
Craps is a great game because it's the only game where you're allowed to throw things and yell, and that's part of the game.
Yeah, I always see them doing that. So I'm going to think, I live in Ohio. Ohio gambling is legal, so we have casinos all over the place here, so it's not that big a deal. But yeah, I'm going to have to try the craps table then.
And you can think you're smart. But the third question, and we'll try and roll through these pretty quickly because I want to get to a couple of those portfolios of risk parity so people understand what they look like, is what is the upside of this investment? And we'll just let that be what it is. Then you ask, of course, what is the downside? And importantly, you need to know who is on the other side of the trade, which are often big pension funds, much smarter people than us. So that's why we want to stick with the averages and buy the market, buy the haystack, as John Bogle says.
Yeah, that's why you want to just buy like an ETF and sit on it, and you're not in and out of there. If you're going to be buying and selling options, you know the people on the other side of that are professionals. So you better know what you're doing.
And then we ask ourselves number 6, which is, what is the investment vehicle? You want to describe that?
In this case, we're talking about funds. So they're either mutual funds or exchange traded funds. That's the investment vehicle. Or it could be a share of stock, or it might be a real estate partnership, or even the real estate itself. You could buy physical precious metals. I wouldn't recommend you do that. You can buy those in ETF forms, and you should buy everything in an ETF form these days if you can do it, because it's the most efficient way to do it. Even if you're going to buy Bitcoin, go buy an ETF. You don't need to be fiddling around with wallets and things like that.
Which one do you recommend? Everybody wants to buy Bitcoin. Which is your favorite?
The most popular one is IBIT. It's the iShares BlackRock one, IBIT.
There you go. We're not giving advice.
You heard Uncle Frank.
There are literally like 12 of them now, and everybody's got one.
Yeah.
That one is the most popular, and why it's relatively cheap and it's very liquid, which means it trades a lot. And that means you're going to get a penny spread on the cost of it.
And then we ask ourselves, number 7, what does it take to be successful? What does it take to be successful, Frank?
Well, that's a question you're asking is, do I need to be like some kind of active trader? How knowledgeable do I need to be successful at this? Or can I just kind of buy it and sit on it, or buy it and rebalance it and not have to think about it too much? It's sort of like, how much effort, knowledge, and skill do I need to succeed in this kind of investment? And typically you need a lot of skill if you're talking about a business or active trading, or you need skills if you're going to invest in real estate. All investments require some level of skill, but the least level of skill is buying some kind of index fund and sitting on it. And then we know that doesn't require much skill, which is why it's a it's a good thing.
Or even like a target date fund. Those have become very popular.
Don't get me ranting on those.
Oh, I won't get you on those. But just saying that most companies now, that's what they default you in if you choose nothing. So that's why I mentioned those.
That's to cover their butts.
Right.
Well, that's the ultimate simplicity principle, where it becomes too simple, according to Einstein.
Right.
And Frank does have many rants on this. He's not a fan.
Okay, we won't go there today.
Episode 333 will break down the target date funds for you. And if you don't like all the yelling and the weirdness, listen to episode 369, where I took that episode, stuck it in a large language model podcast creator that created an artificial podcast of the same thing. Without having to listen to me, you listen to some very pleasant artificial intelligence AI characters.
And they didn't have the great laugh either.
We were talking about that earlier. We don't use AI to create our podcast. They're real, they're palpable, they're raw. And with Frank, it's especially raw. The last couple of questions are pretty straightforward, too. Who is getting a cut? And how does it impact your portfolio? That's where risk parity somewhat comes in there.
Yeah.
And then finally, you need to ask yourself, should you invest? I mean, does it make sense for your portfolio, your style, your risk profile, your reward needs in order to get where you want to go, right?
Yeah, I love these questions that he put together because it kind of covers all of the bases of questions. You can tell David was a professional investor and worked for institutions because he's really got it all in line as to sort of what are all of the things I need to know about this before I invest in it. But those last two questions end up being the most important because really for two reasons. I mean, the first question 9, does this serve a purpose in my portfolio? You basically want every asset in there to have a job, and this is the job it's doing. This does well when things are growing. This does well in a recession. This is when the world goes crazy. You want to be able to have all of these kind of little different assets that are doing those things. But then when you get to 10, it's sort of like, should I invest? Because you only have so much room in your portfolio. You can't put everything in the world in it. And if you're taking something and putting it in, you have to take something out. And so you really have to ask, is this asset A going to do this job better than asset B? And so that is really what you're kind of asking in the end in terms of your personal portfolio. And so a good example is if you are accumulating versus decumulating and you have a bond fund, you probably don't need a bond fund when you're accumulating. So it doesn't serve a purpose for you. And it would be taking up space in your portfolio that could be occupied by an index fund that's going to grow more and accumulate more. So if you have that purpose, you probably don't want the bond fund in there. But if you're in retirement and you want something that is going to perform well as recession insurance or just be a stable thing you can take from, then you do want it because it has a purpose and it's worth some space in your portfolio. I actually use those questions before my podcast became popular. I have about 1,500 regular listeners, but a lot of my first episodes, I use those 10 questions to analyze various assets. And if you go to the podcast page, there's actually a list of a bunch of different common funds and investments. And then it will cue you to go to particular podcasts to hear about the 10 questions about that. So I know off the top of my head that Podcasts 12 and 40 are about gold. And if you wanted to run the 10 questions about gold, you listen to those. There is a list there if you're interested. People keep asking me to do more of those, and it's like, well, I got all these other questions I need to answer. I can't do everything.
Well, that gets us through the questions and begs the question to close out. And we don't want to overwhelm our audience, but we want to give them an idea of what does a risk parity portfolio really look like. And you have 6 in your experiment, your dive bar, but I really want to go over the first 3, just in brief, in brevity. You call them the all-weather or all-seasons portfolio, the golden butterfly portfolio, and the golden ratio portfolio. You have 3 others that are much more complicated, but these give folks an idea.
We're up to 8 now, Bill.
Okay, well, you can tell I don't listen every week. But
Frank loves this stuff. And there's some people out there that do love this stuff and they want to get a little deeper, and you've provided that for them.
It is really the second 2 that are of particular interest, and everything else on there is there for a different reason. So let's talk about those, though. So starting with that all seasons one, that is the portfolio that Ray Dalio recommended to Tony Robbins in Money Master the Game. And so what it represents is a reference portfolio, or if I was going to construct a simple classic risk parity style portfolio, it would probably look something like this. And you'll see it's rather bond heavy because it's really trying to balance out the volatilities of the assets. When I looked at something like that, and I did read this stuff as it was coming off, I read Bridgewater Papers back in 2011 before they really had a website. But the reason I put that there is because that's what people think of when they think of risk parity. They think of that. That is not something you probably want to retire with. So we keep it there as a reference, just so we can have something to compare the other ones against, really, is what it's for. Because it's got too many bonds in. It's only 30% in stocks. That violates the macro allocation principle that we learned from Bill Bengen, that no, you really want to have a portfolio that's at least 40% stocks if you're going to have a good drawdown portfolio.
just to reiterate for people in our audience, it's 30% total U.S. stocks, 40% long-term treasuries, 15% intermediate treasuries, yes, very bond heavy, 7.5% gold, and 7.5% commodities.
Yeah.
We can't go into which funds you use to do that, but you outline them on your website. And these are some investments that are vehicles that our audience is less familiar with or less interested in, honestly. And that's why we're trying to wake them up to this a little bit. The second one was the golden butterfly portfolio, which I find interesting. And the butterfly is a good metaphor or image for this.
Yeah, the golden butterfly portfolio is invented by Tyler, who runs Portfolio Charts. And that's a website that you should get familiar with.
To analyze your portfolio and look at the efficient frontier, right?
To analyze your portfolio on a whole variety of metrics, including safe withdrawal rates and other things. And it's got like 19 sample portfolios. So you can easily compare what you're thinking about investing in with everything from Core 4s to Merriman Ultimates to Boglehead 3 funds to the Ivy portfolio. And it's like an OG fire person. And we go back to the early retirement extreme boards with Jacob Lundfisker in, say, 2010. So I remember when Tyler rolled out his site in around 2015, which was like eye-opening because I had spent the 5 years trying to figure, just kind of guessing. Because we didn't have data, there were so many things we didn't have then that we have now. So there was like, I had no real way of figuring out, well, what is the safe withdrawal rate of portfolio A versus portfolio B? The resources weren't there unless you were a professional or an academic and had access to a bunch of stuff. So he put all this stuff together. He got all of this data together. It goes back to 1970 and covers like 10 different countries and 15 different asset classes. I mean, you can go there and basically put in a whole variety of different portfolios and check them out on his site. But he developed the golden butterfly based on what was called the permanent portfolio, which was invented in around 1980, actually. And so that portfolio, and he was designing it, how can I get kind of the best risk reward out of a portfolio? And so what he ended up with is taking that old permanent portfolio, which was 1/4 stocks, 1/4 bonds, 1/4 gold, and 1/4 cash, reimagining a little bit, adding more stocks to it, splitting the stocks into essentially growth and value. So what you end up with is 20% in a total stock market fund, 20% in a small cap value fund, 20% in long-term treasury bonds, 20% in short-term treasury bonds, and 20% in gold. And it's called the golden butterfly because the gold is like the head and the bonds and the stocks are like the wings. You didn't know that.
No, I knew that. I could certainly imagine it.
So, and he's written extensively on that. I mean, he's been writing there for almost a decade now, all kinds of articles about various assets, various combinations, all kinds of interesting analysis. But that is really should be a primary source for anybody who's really interested in the details of this. And his charts are just really fun to use because he's got a great one that is safe withdrawal rates that has on one axis years, like 15 through 45. And then you can see how for a given portfolio, the safe withdrawal rate would change. Most people think of, oh, it's 30 years. It's only this one year. It's like, no, you can have 25 years. You can have 40 years. You can look at what the curve is on the whole site there for most portfolios that you can devise. So anyway, I would definitely check that out if you're interested in this topic because it's kind of fundamental these days.
And Jackie, the last one he sort of emphasizes, and I think, did you come up with this, Frank?
The golden ratio, yeah, that's my contribution to this.
And the golden ratio is 1.6818, which makes it sound very complicated, but the golden ratio is a symbol for balance known as the phi symbol. And without overwhelming people, I just want to iterate just what's in it. And it's 42% stocks split between large cap growth and small cap value, 26% long-term treasuries, 16%, what is it, gold.
And then the remaining, you have a 10 and a 6 allocation, and those are kind of flexible. And what I've put in for the 10 these days is a managed futures fund, and then the 6% in that example is cash.
On that note, I think our audience's brains just exploded.
Yeah, I know.
I know Jackie's just exploded.
Yeah, it did.
And that's where it becomes a little complex for me.
Or it looks that way on the surface.
It does take some time to get into this, but I mean, don't confuse being unfamiliar with something and thinking it's too complicated because, as I say, it's not that complicated. It's basically just let's make a portfolio that has a few more funds in it that are more diversified because it has a better safe withdrawal rate, and then apply some basic rebalancing rules, and that's it.
Yeah, don't let the name, the golden ratio portfolio 1.618 PHI balance. Don't let that name scare you.
Well, I think, how do you say it? Our radio signal is starting to fade.
But now I see our signal is beginning to fade.
That's how you close your show. And we've kept ourselves to what Jackie, I think, wanted us to. Our first episode with you was about an hour and 50 minutes long.
Put it all on me. Okay, put it all on me.
We go on forever. Maybe we need to add about 30 minutes of SpongeBob to this show. But we're very appreciative of this sneak peek, as you will, and comprehensive look on the other side of what risk parity is, what looking at an investment is, deciding the difference between accumulation and drawdown, which people don't necessarily think about. I mean, I find this very illuminating, and I hope our audience has too, right, Jackie?
Yeah, I think so too. And we love introducing new concepts to our audience. It may not be for everyone. It may not be for you right now, but just the knowledge of understanding what risk parity is, what the goal of even trying to do risk parity, basically another level of diversification, is just going to make you wiser and give you more choices as you decide how you want to construct your portfolio, not just now, but as Frank was saying, at the distribution phase. At some point, you're going to be ready to draw down. Your portfolio is probably going to look a little different than in the accumulation phase. And plus, we always love to hang out with Uncle Frank. He's in our Facebook group. Come join us there. But he just has such extensive knowledge on everything investments, portfolio, and we just love to pick his brain. And when we ask questions, he does answer them.
So, Frank, this has been fun. This has been entertaining. This has been illuminating. We're going to have you back again and again. And maybe we'll just have to do a whole humor episode sometime.
So we can have you laughing the whole time.
On SpongeBob, Talladega Nights, and whatever's rummaging around in there.
Get some Beavis and Butthead in there. And fire, fire.
What's your favorite SpongeBob clip?
Oh, gosh. These days, probably something with Patrick Starr in it, But actually, I think the Sailor Mouth episode probably takes the cake. When they learn swear words, but they cover them up on the show with dolphin sounds. So they're cursing at each other, but it's all these dolphins.
Well, Jackie, any closing thoughts here on this Frank episode?
Well, I like putting Frank on the spot. So, Frank, we have a new administration coming in 2025. Anything you would consider doing different or things to watch out for as a result of that change?
If you have a robust portfolio, which I mean, most people do if they're invested in index funds, no, I would not change a thing. I mean, I think it's very unpredictable because some of the policies that have been talked about would be very deflationary and some of them would be very inflationary. And we're at Forrest Gump's box of chocolates. You never know what you're going to get.
Yeah, I think Bill and I 100% agree with you on that.
I will say that markets do not like unpredictability, which to me, it was funny if you look at sort of the election and what's gone on since then. It's sort of like, okay, the election's over. We know who won. Things are predictable now for like a month. And then and the stock market goes up. Everybody says, yeah, I know what's going to happen. And then in December, it's sort of like, hey, wait, we have no idea what's going to happen. Sell.
Look, you heard it from Frank Vasquez himself, and he's basically saying there's really nothing you should be doing different. We've gone through many administrations throughout history, but I think that question gets asked a lot. What should I be doing different? And people have asked me over the last month or so that same question. So I figured I would pose that to you.
I mean, honestly, the market's had a great 2 years. We should expect less of a good year this year, if not worse. So people think there's a Trump bump. Be careful. The elections and administrations do not really have an impact on the market. We've gone over that in a prior episode. Stay the course and just keep buying, right?
Yeah. Oftentimes things turn out exactly the opposite of what people thought. So the first time Trump was elected, people thought, oh, this is going to be great for energy companies. Everybody go buy energy companies. They did terrible. And then Biden gets elected and it's sort of like, oh, this is going to be horrible for energy companies. Don't buy those, sell those. And they did great.
Yeah, so just keep that in mind. Stick to your plan.
All right. Well, if anybody's unpredictable, it's Frank. You just never know what you're going to get. This has been predictably unpredictable. We're eternally grateful to you, Frank. We value your friendship. We look forward to seeing you at Economy, which is sold out this year. And just thanks. Thanks for being here.
Thank you. It reminds me I need to call up Diana again and find out what she wants me to do.
Yeah, kind of right here. Yeah, this has been amazing, Frank. And thank you to our listeners. We want to wish you a happy new year. We're into 2025. God, haven't the time just flown by, Bill. But we appreciate all of our listeners. We wouldn't be here without you. And we will catch you next time on Catching Up to 5.
All right. See you next week. Bye. The single has faded.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. Our social media maven is Diana Falk, and our editor is Fritz Brizard. We love them, and they keep us going.
Yeah, Jackie, I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofy.com and check out our vetted resources, partners, and affiliates for discounts and their services because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to 5. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to 5. Cheers.